Good afternoon for anyone who's listening, even in the middle of August. Thank you so much for joining. Today, it's only Carlos and myself giving you a webinar. The agenda today is we're gonna give you a quick market update. We're gonna talk about valuation frameworks for crypto assets. And lastly, we're gonna talk about portfolio allocation. And after that, hopefully you have some challenging and interesting questions that we're going to answer at the end of the session. All right, let's start with a market update. What have been the top 3 trends over the last 1 or 2 weeks? A lot is going on in crypto. I know the Bitcoin price, or in general, even Ethereum, they're pretty flat and consolidating. But in terms of fundamentals and adoption, there is a lot going on in the crypto space. And therefore, we just picked 3 of the major events over the last 1 or 2 weeks. The first one was definitely PayPal, the fintech giant that launched its own stablecoin called PayPal-USD or PYUSD on Ethereum. So it's going to be an extra ERC20 token on Ethereum. It will be issued by Paxos. As you might know, they also used to issue the BUSD stablecoin. And Paxos is actually subject to oversight from the NYDFS. And therefore, they're a regulated entity. PayPal itself, they also have a BIT license since 2022, and therefore it's a major move that a giant like PayPal is going into the stablecoin game. Why it matters? PayPal is massive. They have over 435 million active accounts by the end of last year. And if we compare that to Ethereum, for instance, we only have 1 million active users. So obviously, this could be a massive step forward for the average user to adopt crypto. There's a lot of use cases for that. Obviously, you could send PayPal or PayPal USD from one account to another. They also mentioned they're going to have an integration with Venmo, and Venmo is also widely used in the US. So that obviously is a massive step forward and a big chance for PayPal. The thing is, as I know, the stablecoin will only be available to US customers. So if you want to send around PYUSD peer-to-peer, it's only with US accounts. However, you could also obviously send it via the Ethereum network. So the idea is that in the future, you can also use the PayPal stablecoin for DeFi or NFTs and so on and so forth. You can basically use any decentralized application on Ethereum. The question that I ask myself is, okay, why are they actually doing that? Because there's obviously a lot of regulatory uncertainty in the US around crypto. But I think it's just a strategic money move from PayPal. Obviously, if we look at Tether, for instance, they made over 1 billion in profits last quarter. I think Circle also was close to 700 million or even more. And therefore, there's a massive business opportunity for PayPal because PayPal is a payment processor. So that's how they make money. But with stablecoins, it works a bit different. So all of those stablecoin issuers, their backing is mostly with US treasuries. For instance, USDC, like Circle, they have, I believe, over 80% of their backing is with the Circle Reserve Fund, which is managed by BlackRock. And this fund only invests in treasuries, and therefore they make a good 5% on their holdings. And I think, therefore, that's a money opportunity for PayPal, and that's why they're going down the crypto road. Excellent. You got any opinions on that, Carlos? Anything to add?
No, I agree with what you just said. I think it's a massive step toward crypto's integration with traditional payment methods. And it goes in line with what Visa just unveiled, which is basically a solution that would allow users to pay on-chain gas fees with a credit card in fiat. So one of the problems right now with crypto is that it's very isolated from the traditional finance world, in my opinion. And that's hindering merchant adoption, like for payments and use in just widespread applications. And I think that both that the PayPal stablecoin and these kinds of developments by Visa, really what they are is they are a trend towards crypto's integration with existing financial software that will allow for like seamless on and off ramps with fiat. And that's what will enable like ultimately merchant acceptance of stable coins or crypto and whatnot, and this seamless integration between crypto and the traditional world. So I think what excites me most about this move by PayPal. And I also think that PayPal's vice president said that they will not rely solely on the yield generated by US treasuries for the profits. So it would be interesting to see how they monetize the stable coin just beyond getting that yield from the treasury. And in terms of Visa, why does it matter? Is right now, if you want to interact with the Ethereum network, you need to hold a little bit of ETH in your wallet just to pay for gas fees on the network every time you perform a transaction. But with this new solution that Visa has developed, what you can potentially have is interacting with the Ethereum network without having to worry about this inconvenience of having to hold the native token of a blockchain. And you will just need to use your credit card to pay for those fees. This solution uses Ethereum's ERC-4337 standard, which is just the jargon for account abstraction, which basically means you as a user don't have to worry about the back end. You just have to worry about what you want to get done with your credit card. If you want to purchase something, you don't have to worry about how much ETH you have, etc. You just have to swipe your credit card and you would be good to go. So I think these kinds of developments are really positive for crypto's adoption as a whole. And then we also have one final development, which is more crypto native related. Adrian, do you want to kick this in?
Yeah, absolutely. So the last big news was that Coinbase finally launched their layer 2 solution dubbed Base. And yeah, it already gained a lot of traction. They started off with an incentive campaign called On-Chain Summer. So basically, it just incentivizes a lot of people to try out their new layer 2 solution. Obviously, Coinbase or Base is a layer 2 solution, and it's leveraging the OP stack from Optimism, like a lot of other solutions from A16Z and so on. And I think, Carlos, you already did some transactions on Base just to test it out a little bit. The whole thing gained a lot of tractions in the first days, especially due to a little meme coin frenzy. But I think as of now, it's also driven by NFT activities. I know Coca-Cola, for instance, they launched their very first NFT on this new layer 2.
Yeah, exactly. I bridged to Base a few days ago. I moved some funds to the network just to try it out. And let me tell you, it's very good. And in Ethereum, you usually have a transaction fees that goes into the $10 to $20. In Base, it's basically just cents to interact with the network. So it's good for the small participants trying to stay online and on chain. And you're right, Base had a partnership with a lot of companies, Coca-Cola among them, and they're launching NFTs basically every day for the rest of August, which is a really cool initiative. And you have to take into account that Coinbase has millions of users already onboarded to crypto, but at their exchange. And their goal with this is basically move or introduce this millions of users they have on their exchange to basically the on-chain. So I think that this is a really good initiative from Base and could really help towards the adoption of the network.
Let's see how it plays out. I think it's really nice of Coinbase that they're basically a centralized entity, but they're moving more crypto native. I also like that as of now, Base doesn't have its own native token, but let's see how it gains traction and if all the hype around it is sustainable. Because obviously a lot of times people are just hyped about new projects at the very beginning, but it's really hard to sustain the users. Coinbase, for instance, they launched an NFT marketplace in the past as well. And there was a lot of hype around it because Coinbase is a name. It already has a lot of users, but the Coinbase NFT marketplace never really succeeded. But hopefully it's going to be better with the layer 2.
That's true. That's true. And for the business itself, Base represents a very lucrative opportunity because right now they have the only sequencer that posts transactions to the Ethereum main chain. So that's a huge source of potential revenue for Coinbase. So I imagine they have right now an incentive to really keep the momentum going. And it will be interesting to see that if in the future they choose to decentralize, how it will affect the revenue for the Coinbase, the business as well. Because I imagine they would be doing that at a sacrifice of a bit of revenue. But let's see.
Absolutely. I think to round this up, all of those three trends, it perfectly ties in with our overall theory and narrative and thesis, which is basically that crypto is all about infrastructure. And going forward, the average user won't even notice that they're using crypto. For instance, if you pay with your Visa card, everything is handled in the back end. You're just using the crypto rails. But you as a user, you don't really notice and you might not even care. And therefore, it's really important that we get this better UI and user experience.
Yeah, just going to answer a question quickly from the audience about the sequencer. So basically, when you have a layer 2 on top of Ethereum, you need to batch and order the transactions and post them on the base chain, which is Ethereum, right? So the sequencer is basically the tool that allows you to do that. But right now, Coinbase have sole control over that sequencer. So right now they have two main sources of revenue, which is the transaction fees on the network. And they also have the maximal extractable value, or MEV, that they can extract from ordering, censoring, or including transactions in certain order. And so that's a good source of income for Coinbase, the company, right now. Although in the future, it will be decentralized, or it will be a shared sequencer, as it's called. That source of revenue will dilute for sure.
All right, I think that's it for the market update. Let's jump into the topics of today. And we start off with valuation frameworks. So overall, the next two topics, for both of those topics, we have dedicated State of Cryptos, like an entire magazine, really going into the details. But today, we're just going to give you like a high-level overview about valuation frameworks and portfolio allocation, because we recently updated some of those numbers. Maybe we're going to start off with you, Carlos.
Sure. So just to give you a brief overview of what does it mean to value an asset before we dive into the actual valuations themselves. 𝕂𝕂𝕠𝕕𝕖𝕂, who is a professor of finance at NYU, distinguishes between two valuation approaches, which is basically intrinsic or relative valuation. So intrinsic valuation is really the value of an asset as it relates to its fundamentals, namely its cash flows, its growth, and risk. And so we usually compute intrinsic valuations with a discounted cash flow method. That is the net present value of the future cash flows adjusted for timing and risk, of course. And then we have, on the other hand, relative valuation approaches, which are usually based upon multiples or comparables. And this is basically just also called pricing, because what you're doing is basically you're estimating how much to pay for an asset based upon what others are paying for similar or comparable assets. So think in traditional finance in terms of price to earnings or price to sales. Those are relative valuation approaches that are very common in the equities world. So if we move on to the next slide, what we tried to do in the magazine successfully, I would say, is that we computed the valuation of Ethereum using a discounted cash flow method. Why did we do this? Because Ethereum is a proof of stake crypto asset. What that means is that validators must commit a portion of their capital, in this case, Ethereum, to gain access to a recurring value stream of rewards generated by the network. Because they have a source of cash flows, we say that proof of stake crypto assets are basically capital assets in the asset superclass framework. So the first step to estimate the DCF valuation for Ethereum would be to estimate the cash flows during the life of the crypto asset. And Ethereum stakers have two sources of revenue. The first is transaction fees that people pay every time they perform a transaction on the network. And the second is the token issuance or token inflation. That is the ETH that comes into the network every time a new block is produced. So from the merge, which marked Ethereum's transition to proof of stake, to June 30, 2023, Ethereum had $275 million in fees, which translates to annualized fees of $350 million. And then the token issuance from September to Q2 2023 amounted to $850 million, which translates to annualized issuance of $1 billion. And so total cash flows for the network in the first year amounted to $1.43 billion if we sum these two components. So what we did next was estimate the expected future cash flows based on the one that we just estimated and the lifespan of the crypto asset. Here we assumed 20-year lifespan of Ethereum. Of course, what you could do instead as well is just project 20 years and then assume a stabilization rate for perpetuity. But we just chose 20 years out of simplicity. And then what we did is we had a three-stage growth model in which we have aggressive growth in the first few years. Then we have an incremental decrease in that same growth. And then we have a stabilization phase as the asset matures. And so that way we estimated the revenues of the Ethereum network based both on token issuance and on transaction fees generated by validators. And then finally, what we did was we estimated the discount rate to apply to these cash flows to get the net present value. And this almost becomes a philosophical question, which we in the research team have spent a lot of time discussing what would be the most appropriate discount rate to apply to crypto assets. And what we chose to do here, just for the sake of simplicity and just something that also makes sense, is to apply a lower bound discount rate and a higher bound discount rate that reflects the riskiness of the asset. So for the lower bound discount rate, we use the compound annual return of the NASDAQ 100 in the last 30 years, which is 13%. The assumption here, obviously, is that ETH is like a tech stock, which is technically, and as we know, not true. But we just use that assumption for the sake of the analysis, as we don't really have a discount rate in crypto right now. And then for the higher bound discount rate, we used 19%, which was obtained using the Fama and French three-factor model. This is very similar to the capital asset pricing model developed by Markowitz, but it also takes into account market premium, size premium, and value premium. So it's a little bit more precise, I would say. And the results tell us that with a 13% discount rate, ETH is actually undervalued right now, as the price per ETH would be $2,700 instead. And with a 19% discount rate, the price of ETH will instead be $1,300. And what I want you to notice now is that the discount rate is very sensitive, or rather the price is very sensitive to the discount rate. So it's a big assumption, and we try to be a bit aggressive here to really reflect the riskiness of the asset. But of course, you're free to run your own assumptions, and investors are free to run their own assumptions when they perform this analysis.
When it comes down to DCF, it always based on a lot of assumptions. But as Carlos said, this is a very, I would call it a conservative approach, because we did use a very aggressive discount rate of 13%. Usually for traditional DCF, mostly you use, a 10-year treasury. But we thought this the NASDAQ, for instance, represents the opportunity cost or the required return on capital. And therefore, you see those numbers being very high.
Exactly.
If we go to the next slide, we now look at Bitcoin. And this time, it's not a fundamental valuation, it's a relative valuation, because Bitcoin is a proof of work asset. And here the approach is pretty straightforward. What we did here is basically, as Bitcoin is an international, neutral, emerging store of value, it comes very close to gold. And therefore, the comparison to gold does make sense to a certain extent. What we did here basically is we compare the market cap of Bitcoin to the market cap of gold and see how the valuation or the price of Bitcoin would change if Bitcoin is able to capture a certain percentage of the overall gold market cap. The gold market cap at the moment sits at almost 13 trillion. It's 12.72 trillion to be exact. And if we look at the numbers, if Bitcoin would be able to capture, for instance, 20% of gold's market cap, we would already be at 125,000 for one Bitcoin. If we assume 30%, for instance, it will be 188,000 per Bitcoin. So you might have seen a lot of predictions of Bitcoin at half a million or a million. So this assumption is mainly based on the fact or the theory that Bitcoin could become the new digital gold. And if Bitcoin really has over 13 trillion of market cap, the price will be over 500K.
Yeah.
What's really important to add here, though, is this only takes into account the store of value narrative. Obviously, there's other things we could consider, for instance, Bitcoin as a payment network or even as a smart contract platform, as we have seen with ordinals, stacks, BRC20s. But looking at this relative valuation, it's mainly just based on the assumption of a store of value narrative. Carlos, you want to add anything here?
No, I think you mentioned it perfectly. I think we can move on to the valuation ranges. So what we did in the magazine, we not only did the DCF and the market sizing approach, we also did many other methodologies to value Bitcoin, because really crypto asset valuation remains a topic that still needs industry-wide consensus. So we try to apply many methods to value these assets and show you like the different trade-offs and that it is possible to value crypto assets. For instance, in Bitcoin, you not only have the market sizing approach, you also have the NVT, which is the network value to transactions ratio. If you see, this approach says that Bitcoin is overvalued right now, but that's because it only takes into account Bitcoin's use case as a medium of exchange. And as we know, the primary use case of Bitcoin right now is a store of value. So basically what that means is that the velocity of the asset itself is not very high. And as a result, it's not used solely for payments, but it's also dormant in people's wallets because they're using it as a store of value. We also have the market cap to thermocap ratio. The thermocap is basically the aggregate security that is spent by miners to secure the network. So this is really a ratio that tells you how much is the Bitcoin network valued in relation to the security that miners have spent to secure the network. And with this, we see that Bitcoin is in the range right now. The lower bound, if I'm not mistaken, is the average market cap to thermocap ratio in the past 10 years, whereas the upper bound is the median. And the median, what the median does, it doesn't take into account outliers. And so it's a more accurate measure of the value. And then finally, we also have the cost of production to mine one Bitcoin. Here, the lower bound estimation is the electricity cost, the average global electricity cost to mine one Bitcoin as of Q2 2023. And the upper bound is the total cost to mine one Bitcoin. So taking into account capital expenditure by miners as well, and how much they spend in average to mine one Bitcoin. Here in the cost of production, I want to be very clear that we are not suggesting that the cost of production should determine the value of Bitcoin, because doing so would be to assume a labor theory of value, and we know that's false. Simply what we're doing is estimating basically a lower bound estimation for Bitcoin, because miners are basically forced sellers of Bitcoin in the network. So when miners are struggling in terms of profit, that can give you behavioral analysis that you can use as a lower bound estimation for Bitcoin, the asset. And that a lot in commodities in the real world, where the cost of producing a commodity is below the price of that commodity. The producers usually abstain from selling that in the market just to not incur losses. So we can see that from miners as well, where the production cost is below the price of Bitcoin, then miners might be reluctant to sell that Bitcoin just to not incur losses and wait until the price is higher to try to get a profit out of that. And so that really tells you the behavioral analysis of miners and how that can play into Bitcoin's price.
Yeah, I think it's always important, and Carlos mentioned that already, is there's a lot of different approaches, but all of them have their limitations. But it's just good to have different point of views and basically make up a range just to get a better understanding where the actual value could lie. And lastly, down here, you see the Ethereum range that we just discussed between 1,300 and 2,700. Obviously, the lower bound with less aggressive discount rate and the upper bound with a more aggressive one. It's really important to understand, and we mentioned this earlier, if we, for instance, would use a 10-year treasury or something around 5%, this valuation would go up significantly. So again, this is a very conservative approach, but feel free to download our valuation state of crypto or play around with this model yourself just to get a better understanding. All right. And then lastly, we come to our last topic, which is now we discussed how would you possibly value a crypto asset. And now we're talking about how could a crypto assets, or in this case now Bitcoin, fit in a traditional portfolio. We also have a dedicated state of crypto here. So what we're going to show now is just like a sneak preview. If you download the entire magazine, there's way more information. So what you can see here on the very left, we have a benchmark portfolio, very traditional portfolio, 60% equities, 40% bonds. Then all the other columns, we have a 5% Bitcoin allocation, but with different rebalancing frequencies. So we see here daily, weekly, monthly, quarterly, and even no rebalancing. And what we can see here is that in any case, a Bitcoin allocation of 5% was always able to improve the overall performance of the portfolio. So for instance, if we compare the cumulative return of the benchmark, which was 154%, with no rebalancing and 5% Bitcoin, it would have gone up to 570% performance, cumulative return. The similar picture for the annualized return. However, the problem here is, if we look at the annual volatility, it went up to 48%, which is obviously not a smart move and not sustainable for a traditional investor. That's way, way too high. Therefore, the key finding in this analysis is that rebalancing is really the key. It's the most important thing when investing in crypto assets within a traditional portfolio. Because what we can see here, for instance, if we have an annual rebalancing, we improve the annual return from 6% to 17%. The volatility, however, only goes up from 13 to 16.6%. If we do it quarterly, the volatility even only goes up by a few percentage points, maybe 0.5%. So as we can see, the risk-adjusted returns overall, which is expressed in the Sharpe ratio, would increase significantly. Maybe just to note here, the time period we looked at, the start date of this analysis was end of 2014 until mid this year, 2023. And we chose a very long time period because we didn't only want to capture the good days, but also the bear markets. And therefore, we had a long time period where we capture both the ups and downs. Obviously, we have more analysis with different timeframes, but Bitcoin itself or crypto, it shouldn't be looked at as a short-term or a trading opportunity, especially within a long-term 60-40 portfolio. That's the summary that we just discussed. Improved risk-adjusted returns, that rebalancing is absolutely key. And maybe the last one is that timing doesn't really matter. There's something, so the hit ratio, and it shows that no matter when you invest within this time frame, in 80% of the time, you always outperform the benchmark within a year. And it's even 100% if we look at a 3 years time period. Do you want to add anything, Carlos, here?
No, I think you summarized it perfectly. And I think there's a quite surprising result from the 1% Bitcoin allocation. Yeah.
Absolutely. So here we look at the same thing, same chart, but this time we looked at the 1% Bitcoin allocation. So again, same picture, the cumulative return improves in any case. The volatility is only limited if we use rebalancing. So rebalancing is still key. However, the key finding or the most surprising finding here is that if we look at a 1% allocation with a quarterly rebalancing, we can see that not only the annual return went up from 6.17% to almost 7.5%, also the annual volatility actually decreased from 13.6 to 13.36. Obviously, it's just minor, but it's very surprising that this small allocation of 1% can actually decrease the overall return of the entire portfolio. And again, obviously, if we look at the Sharpe ratio, we can see the risk-adjusted returns increase significantly with this very small allocation. Do you want to add anything here, Carlos?
Yeah, the reason that the volatility is able to decrease is that historically Bitcoin has had a very low correlation to traditional assets, in this case, equity and bonds. Really, the correlation play between the assets or the returns of these assets is what allows us to have a decreased volatility. And it's really one of the main value propositions of Bitcoin for traditional investors, I would say, which is it is not very correlated to equities and bonds historically and over long-term horizons. It really is its own asset class because it really is moving by its own value drivers. And so I just would like to point that out, which is it really has a low correlation to traditional asset classes. For instance, in March of this year, Bitcoin showed even a negative correlation during the March event where we had a Silicon Valley Bank went bust in the US and the Fed having to step in to save depositors. We saw that there was a huge rally from Bitcoin, and Bitcoin actually showed an increased correlation to gold, which really tells you that it is an all-encompassing asset that's a hedge against currency debasement, but also bank risk as well, and that investors can use it for sure as an effective portfolio diversifier.
That's absolutely true. Obviously, last year, the correlation increased significantly to the equity markets, for instance. But to be honest, last year, all asset classes trended to a correlation of 1. And it's pretty nice to see that this year we had this decoupling, especially during a time like the banking crisis, where Bitcoin did show its true market fit, in my opinion. Again, here the summary. I think for us, it was also surprising to see, okay, that a small allocation can not only, increase the overall return, but also slightly reduce the volatility. And again, that timing really doesn't matter. It's like many other assets, it should be considered as a longer term, at least not a short-term investment. But again, everything we say is no financial advice. We're basically just pointing out our findings and basing all our assumptions on the numbers that we found out. So don't take it as an advice. And I think that's it. I think lastly, we just want to point out some of the other research materials that we have. Obviously, if you never heard about our Dune analytics dashboards, you should definitely go scan the QR code and check them out. Dune Analytics is a free platform where you can create so-called on-chain analytics dashboards. And it's really mind-blowing because the beauty of the blockchain is everything is transparent. It's like the world has one bank account, but the problem is there's so many transactions, you can't really read them. And that's why our team, especially Kareem, Carlos, and Tom, shout out to them, they build amazing dashboards where you get a good visualization of some of the on-chain activity that is taking place. And lastly, we have a QR code for our research in general. Obviously, as I mentioned, all of the portfolio allocation or the valuation frameworks, everything is available on our website. Feel free to download it for free. And if you have any questions, feel free to reach out to Carlos or myself. And Carlos, if you have anything to add.
No, just maybe mention that we recently did an update we of course have an entire magazine with our valuation frameworks and portfolio allocation that we did last year, but we also did an update with the Q2 numbers of this year so that you have the latest insights in that regard.
Absolutely. Feel free to reach out to us and we're happy to send you through the slide deck if you want to. Good. I think now it's time for Q&A. If you have questions, concerns, feel free to put it in the chat and Carlos and I, we're happy to answer them.
We have a question about Bitcoin's volatility. It's an anonymous question. Any thoughts on the reduced Bitcoin volatility over the recent months? Will crypto now be a stable asset class?
You want to take that?
I was just going to say that if we look at crypto's history, Bitcoin was created in 2009. Since then, a lot of cryptocurrencies have emerged, and it's only natural for a new asset class to be very volatile. If you look back at 2014, 2017, Bitcoin's volatility was very high. You could see annualized volatility in the ranges of 80% even. Whereas you have an annualized volatility of the S&P 500, let's just say, of let's say 20%. So really, Bitcoin's volatility was very high in the early years. And as the asset matures, what you can expect is that volatility to decrease over time, because not only is it maturing, but the infrastructure around it is maturing as well, meaning the liquidity, of course, the market depth. And so that really improves the asset as a whole and allows it to be less volatile. What I would say is that this year, indeed, in the past few months, Bitcoin volatility has been reduced or compressed dramatically, which is not normal, let's just say. But usually, if you look in the past, in periods of compressed volatility or prolonged compressed volatility of Bitcoin, that's usually succeeded by a very big move. So what you can expect is that in the next few weeks or months, we see a huge uptick in volatility just because it has been compressed for so long.
Absolutely. I couldn't agree more. It's been very flat over the last couple of weeks and months. That's true, which is very unusual. But also it's summer, we're slowly getting out of the bear market, especially retail. There's not a lot of interest for crypto right now, to be honest. It's slowly picking up. And on the institutional side, there might be still some concerns or uncertainties and unknowns. But I totally agree with Carlos. Markets always compress and then they expand. A longer period of low volatility is always, or most of the times, followed by a bigger move, either to the upside or downside.
We also have another two questions. If you had 1 million to invest in crypto, which cryptos will you take in your portfolio? Adrian.
Again, we don't give financial advice. I can give my personal view on that. I don't know. It really depends what kind of investor you are, how long your time horizon is. Also, if it's in a bigger portfolio, it should be just a small allocation. But my personal view for a smaller crypto portfolio, obviously Bitcoin and Ethereum would take up most of the chunk, like 80% or even more. And then 20% I personally would play on smaller altcoins that might have potential, looking at layer twos like Polygon, Optimism, stuff like that.
Yeah. And then we have another question. What's your view on the crypto ETF applications and probability of their approval?
Since we're in this process, we can't answer any question on that topic right now.
Then we have our Stellar and Stacks as smart contract platforms according to 21 Shares specification. So I can answer that. Stacks is weird because it is a smart contract platform technically, but it is also a scaling solution because it sits on top of the Bitcoin network and it's helping it achieve more functionalities because as we know, traditionally Bitcoin is just a payment network. But with Stacks, you can add smart contract functionality for Bitcoin. So what I would say is that Stacks is both a smart contract platform and is also a scaling solution on top of Bitcoin. And in regards to Stellar, Stellar has recently launched a smart contract platform. I think it's called Oberon or something like that, in which you can issue basically stable coins pegged to various fiat currencies. But I would say that the main value proposition of Stellar is just to act as a bridge between the traditional world and the crypto world. So they have really been a leader in the category of enabling seamless on and off ramps from cash to crypto and vice versa. And you can see that with, for instance, their partnership with MoneyGram, which is one of the biggest money transmitter companies in the world. They have a partnership with Stellar that allows MoneyGram customers to onboard with USDC on Stellar and off-ramp USDC on Stellar to cash. And then we have one final question, which is, have you modeled a pricing scenario in which the traditional institutional funds have 1% to 5% Bitcoin exposure?
Not that I'm aware of. I think I saw something similar on Twitter where they made an assumption if 1 to 5% would be in Bitcoin, but I have to admit, I can't remember what was the outcome and the actual price, but it's a good suggestion. We could look into it. Thank you.
Perfect.
I think there's no more question. Yeah. Maybe to the classification standard, just one more thing. It's important to know that some assets or some projects, they might morph into something else, or basically they could just touch more than one sector. So Stacks is a good example, or also at the moment we see a big trend of previous layer 1 or smart contract platforms actually becoming layer 2s on Ethereum. So Chelo recently announced that they're going to move on to Ethereum. And I think Phantom is also contemplating if they become a roll-up on Ethereum. So it's a moving organism, basically.
Perfect. Yeah, absolutely. When there are assets that might fit into 2 or more areas, what we usually do is we try to place it in the area that makes the most sense for the asset on an asset per asset basis. But yeah, thanks so much for the questions. I think it was a very interactive, very insightful questions as well.
Absolutely. And I think that's a wrap up. Thank you so much for everyone that showed up, even in the middle of the summer. I hope you enjoyed. If you got any questions, feel free to reach out to us. And other than that, enjoy your summer evening. Bye-bye.
Everyone, bye-bye.